for joining. I think we might have a couple of people trail in, and that's okay. This webinar is being recorded. Just wanted to welcome everybody to the Anew Advisors webinar educational series. Thank you for joining us again today. My name is Liz Notling, and I'm the Director of Operations for Anew Advisors. Today, our webinar will be focused on the topic of traditional versus Roth retirement options. We do have Glenn Colwell and Nick Schneider on presenting today. Just a few housekeeping things before we get started. Today's webinar, again, will be recorded. During the presentation, you may ask questions via the chat down at the bottom or that Q&A button down there as well. Otherwise, there will be a Q&A at the end of our session. So without further ado, I'd like to welcome Nick and Glenn.
Thanks, Liz. We'll get started here. And just so everyone is aware, hopefully at the bottom of your screen or the top or the side, depending on how you format your home screens for these, there should be a Q&A button that you can press on and actually type in questions at the end. We'll address all questions when we get to the end. Here's the agenda today. We'll talk a little bit about who we are. Most of you probably know who we are since we sent out this invite to our existing clients, both on a state level, local level, individual member, as well as some additional prospective clients. But for the bulk, you probably know who we are, so I won't drill too deep into that. We're going to highlight our monthly education events, which this is one of them right now that you're attending, and then we'll dig into the traditional versus Roth and next steps. I love my colleague, Michael Bongiorno. He always says we look like the Brady Bunch when it comes to this particular picture. I think we all agreed as a team we need to update our headshots. But I'm Glenn Colwell, Managing Director of Anew Advisors. And then I'm just going to go from left to right. Michael Bongiorno is the Director of our Fire Services for Business Development, former firefighter, retired president of a local union in Milwaukee. And then after that is Anthony Zilli, my colleague and partner, also a Director of Business Development for all different types of areas for our business. Below that is the lovely Liz Notling, looking pretty fabulous in that picture. I think you have the only good picture, Liz, out of all of us. And then to the right of that is Sean Lauda. Sean is a Director of Business Development for our law enforcement, former police officer and former president of the Milwaukee Police Association Union. And then last but not least, Nick Schneider. You're actually kind of looking like your picture right now. Without,
a little bit.
Yeah, without the mustache. Nick is a fabulous addition to my team before we started this joint venture with Zilli and creating Anew Advisors for the last several years. Nick is a key integral part. Most of you talk to him from behind the scenes and the data input. So we can move on from here. We as a team recently dug into our mission, vision, and values. And I will tell you without a doubt, the one thing that shines on this particular page for me is grit. And I say that because when we have a team meeting, all of us that are participating, whether it's Liz, Anthony, Mike, Sean, Nick, myself, we are relentless on each other, making sure we're holding each other accountable. And making sure we're doing not only the right thing for the firm, but most importantly for our clients. And it's just sometimes I feel like I want to record our team meetings because we really hold each other accountable, and that is all for the benefit of you. Brief history. This is my 23rd year in the business of investment management. And I've had the opportunity to meet Anthony Zilli about 4 or 5 years ago. Now I'm losing track of time. And he came to me with his business model of servicing the fire service. And I shared my vision in servicing some of the law enforcement. And we decided to meld firms together and really focus on this public safety space. And it's been a tremendous success for us. We feel very privileged and honored to service law enforcement and fire service across the country. Between Anthony, Nick, and myself, we have over 60 years of investment experience. And then between Sean, Mike, and Anthony, over 60 years of first responder experience. The key with Mike and Sean being not only in their respective fields leaders, but also leading the unions on behalf of the members and really caring about the members. This is our 2023 education calendar. What I would highlight here is, obviously we're sitting in March and we're going to do this Roth versus traditional. But these are actually topics that have come from either surveys or conversations with our clients about what's important to them or what keeps surfacing to them as far as questions, or they're not quite sure how to tackle these particular topics. One thing I will highlight is when we do a particular Zoom or in-person meeting with a state, local, or individual member, we really focus on our roadmap process. And you're going to see a little bit of a screen at the end of that. But I really would encourage all of you to either call Sean or Mike or email them or text them and discuss our roadmap process. It glues together all of your financials as an individual and as a family. And it is really the differentiator for us and how we help communicate and advise our clients. We will actually go through one of those in May. And then I think there might be one more, right? August as well. So we will highlight that a couple times throughout the year. Financial training, this is interesting. We've always done this, but we've formalized it, much more formalized it, not only in a training program, but collateral material. And we've rolled this out to the state of Wisconsin, state of New York, state of Missouri, both on the member aspect side, individual member side, through the local leadership and state leadership, as well as through chiefs. We've gotten tremendous feedback from the chiefs in regards to helping train their particular officers or firefighters. Financial training is huge. Financial stress is huge at all levels, whether you're a beginner or you're ending your career. Again, it kind of all accumulates into this roadmap that we help provide advice between your pension, your 457, spousal assets, or any other outside assets you'll see. All right, topic du jour, right? So traditional versus Roth. There's a lot of confusion around this topic, and in regards to what you should do or what you might want to do, we'll dig into a little bit deeper, but frame yourself in mind inside your 457 plan and making a choice of traditional Roth. I would say the majority of plans have a Roth provision, some might not. If they don't, you need to talk to your administrator at the 457 plan about adding a Roth. If there's questions or confusions, we'd be happy to jump on a call with them and you. So traditional, which everyone should be accustomed to, but we'll drill in here at a high level. Your money goes in pre-tax. So you're actually making a contribution out of your payroll into the 457 for your municipality. And you elect how much you want to go in. Some might elect in terms of dollar amounts, like $200 or $300 a paycheck. Some might elect in terms of percentage. It's really dependent upon your municipality and the payroll and how they want to adjust your paycheck to contribute to your 457 plan. So again, money enters the account before taxes. In regards to distributions, because you don't pay taxes up front and it grows tax deferred, you will pay taxes at time of distribution. So when that happens, you need to be aware of how much is coming out and how it affects your tax rate. We are not accountants. We can help you and help you understand maybe possible or potential tax impact, but ultimately you will need advice from an accountant. Inside the 457, it's a very valuable registration from the IRS. Unlike the private sector, the public sector that has a 457 plan, if you take money out before you turn 59 and a half, you do not pay a 10% federal penalty. That doesn't mean you won't pay taxes. You will pay Fed and state taxes. You just won't pay the additional penalty incurred by the federal government on non-457 plans. So for instance, if you're in a 401k or a 403b in the private sector, you would receive a 10% penalty if you took money out of that account prior to turning 59 and a half. And that's what explains the IRA as well. Depending on the state, there might also be a state penalty. So for instance, in Wisconsin, the Fed penalty is 10%. The state penalty is 6% if you're taking money out before age 59 and a half. That does not apply again to the 457 space, but you need to check with your accountant and you need to check with the administrator to see how it might apply to you in different states. Some providers, 457 providers, when you roll money out into either a paycheck for you or you wire it to your local bank account or you transfer it, they might impose a mandatory tax withholding at the Fed level of 20%. It's typically a box on the form. Just know that sometimes that can be a very good thing because as you take a distribution out of a 457 in the pre-tax bucket, you are going to pay taxes on it. And if you withhold at least 20%, that will help with the tax bite at the end of the year. You are going to get a 1099 at the end of the year showing your taxable distribution. And that's what you send to your accountant, and then they will figure out how much taxes are owed on that on a Fed and or state level. Next quote. Roth. It's an extremely valuable tool. I will say this is probably one of the most added values we give when you go through our roadmap exercise, because listen, at the end of the day, I'm going to make a statement here. This is not political. If you think taxes are going down in the future, then maybe Roth might not be as attractive to you. I highly doubt it. If you've seen the environment that we're living in as far as spending at the government level and the individual level, as far as deficits go, you need to understand how to use a Roth component to your 457. And the main overarching theme is you will pay taxes up front, unlike your traditional 457 contribution, where the money goes in tax deferred. That's not the case with the Roth. You're going to pay your tax up front. And Nick's going to go through an example of that, an actual math example in a moment. You'll pay your tax up front. The money will grow tax-free and come out tax-free. So just so long as you have it in there for 5 years and turn age 59 and a half. So there's two variables you need to accomplish. This is why when we take you through the personal roadmap, we're very adamant about, do you have a Roth now? And if not, start one now. That clock is ticking for you. You need the 5 years and 59 and a half in order to maximize the tax-free distributions. And the old saying of, well, you might be in a lower tax bracket when you retire, it just doesn't hold true. I mean, between Nick and myself, we've done hundreds, if not thousands of these roadmaps, especially for public safety first responders. You get a pension. That's earned income. That will automatically put you in a tax bracket. Then you take distributions out of 457, or if your spouse works, or if you have another job, all that accumulates into earned income and thereby subjects you to a tax bracket. So the more dollars you can put into a tax-free bucket, the better off you will be. Some rules by the IRS, it says that you might be able to access it before that 59 and a half and 5 years, you become disabled. That's a qualifying event. You will have to prove disability to your employer and the administrator. Normal distributions start after your last paycheck. When you actually retire and you get your last paycheck and you separate service, that's typically when normal distributions can take place. When you're putting money into the Roth component of your 457, remember you're getting taxed up front. The money grows tax-free and can come out tax-free as long as you reach 59 and a half and it's 5 years in there. You can have access to your contributions. Again, I would check with your employer and your administrator of your 457 plan, but you should be able to have contributions that you put in to have access to without the 10% penalty. It's really the growth and the distributions of that growth that the IRS wants to make sure that you're meeting that 5 year and 59 and a half. I say that we are very reluctant to have you do that. Your 457 is not an ATM machine. It's really there for after you get done working at your job and making sure you're subsidizing your lifestyle in addition to your pension. So it is very valuable registration to use. Nick, do you want to comment on Backdoor Roth for those that might want to think about that strategy?
Yeah, occasionally what we will run into is, especially with couples where income is higher, the Roth can actually be phased out. And that's a good question for your accountant. But when your income starts to get too high, the government says you can't contribute to a Roth IRA anymore. Well, there is a way that we can actually work around it. So if your income for a married couple, it's around $215,000 between two people, what they're going to say is at that point, you can't contribute anymore, but we can still get funds into a Roth if we want to get the tax-free growth. What we do, and we can help you with this, is we open up a traditional IRA, you make the contribution to the traditional IRA, and then we convert it to Roth dollars and pay taxes at that point when we convert it to the Roth. So it is an extra step, but it does allow you to still take advantage of the Roth and get tax-free growth. And those conversions are something we can do later in your retirement as well. Conversations that we might have with you when we go through your roadmap is, okay, we have a large pre-tax bucket. We might want to convert some of that over to Roth so we get some tax-free growth so we can build that bucket of money as well. And we'll do that in conjunction with your accountant.
Yeah, thanks, Nick. I would just, let's make this clear though, this is an additional strategy beyond the Roth 457.
Yep.
Yep.
This is once it's outside of your 457.
Right. So as Nick mentioned, IRA, earned income, taxable account. Those are strategies that we can help you address on a one-off, either going through our roadmap or just asking questions to us. But please make sure you reach out to either Mike Bongiorno or Sean Lauda. All right, thanks. Nick, why don't you take this? The rest of it?
Just a couple other things we see that can be important, whether it's just for IRAs typically, that we see a lot more of this, but like say you're a firefighter and your spouse has decided not to work, you can still start an IRA or a Roth for them. So what you can do is you start a Roth on their behalf, and as long as you have enough earned income for both of you to meet that limit, you can still fund a Roth for your spouse, even if they are not working. The other thing you want to do, I'm going to jump to point 3 here. Make sure you invest the funds. When you do it in IRA or sometimes even in the 457, sometimes it's going to sit in cash, especially if it's in an IRA. Funds are going to initially go in as cash. You need to make sure that the funds are invested if you're doing it on your own. Same thing in your 457. Sometimes the default when you put money in is it's going to sit in a cash account, and you want to make sure that you're putting that money to work for you. Another thing, just a quick reminder, you have until April 15th. So if you haven't made your Roth or IRA contributions for 2022 yet, you can still make your contributions for 2022 all the way up until April 15th. When you make them, if it's through a brokerage firm like Charles Schwab, it's just a box you check. They're going to ask what year you want the contribution to be for. So you do still have that option. Like Glenn mentioned earlier, inside the 457, you might be able to take some hardship withdrawals. You got to qualify. We don't normally encourage it, but like Glenn said, depending on the plan, it is an option. If like a disability happens and you need some funds out, you are able to access those dollars. And then last but not least, we want to make sure you knew what your contribution limits were for 2022 and 2023. These are your 23 limits. So this is where being able to contribute to these buckets inside the 457 is really important. If you look at your IRA, you can only contribute $6,500. And then if you're over 50, you can add an additional $1,000. Inside your 457, that contribution limit is significantly higher, all the way up to $22,500. And then if you're over 50, you can contribute an additional $7,500. And then that asterisk at the bottom, in terms of being able to add more funds, depending on your plan, you may be eligible for a special catch-up contribution. And if you have questions on that, you can feel free to reach out to us and we can dig a little deeper for you.
Yeah, I would really, thank you, Nick. I'd really stress the importance of the difference of level of contribution. We're talking to a lot of firefighters and police officers that are starting to plan their retirement, and they're sitting at 49 or 50, and maybe they go at 52, 53, 54, 55, and they're trying to understand that. Now's the time to use that maximum contribution allowance in your 457 plan and really sock away some dollars. And then imagine putting that in the Roth bucket of the 457 and having that grow tax-free for you to access down the road. It becomes a huge component to your lifestyle and your income replacement numbers when you do pull the plug, so to speak, and retire.
So this is kind of the question that everyone kind of wants to know, right? Like, again, without knowing your individual situation, we can't really give advice, and we're not accountants, but this is a real simple math example showing what the difference can be at the end for putting money in to your 457 in a pre-tax or putting it in as a Roth. So what we're seeing is we're just using a base salary of $35,000. The second line is if you were to contribute before tax, right? So this is our traditional, this is like the standard contribution for your 457 at 6% or $2,100. And what it's showing is what the salary comes to, right? Because that money comes out pre-tax. So now it looks like your income's a little lower versus our Roth contribution on the right-hand side. How much you're paying in federal income taxes, and then what it looks like Roth, right? The same 6%. So we're putting showing an example of putting the same dollar amount into each. And then the annual net take home pay. So you will see a little bit more in your pocket now if you put money in pre-tax versus the Roth. And that's that $315 you're seeing. So you put $315 more a year into your pocket in this example, or $11,000 roughly over your career. And that's your total contribution, is that line of $2,100 into each, right? So we're trying to compare as close to apples as we can for putting $2,100 into each type of account. So then we jump down into the projected balance. So we just used a 6% number for growth over 35 years. So at the end, let's say each balance, either a traditional or Roth, if you did it for your whole career, is going to look the same, $248,053. What happens then is in that pre-tax bucket, you're going to pay income tax at that same 15% rate. And so the taxes paid come out to $37,000. Taxes on distributions paid is $0 coming out for the Roth. So that balance after taxes, $210 for your traditional, but still $248 after taxes for the Roth because you paid those taxes on the front end. You're putting that $2,100 in. That comes out to an additional $37,000 in your pocket from the Roth because we didn't have to pay those additional taxes at the end. But now, to be fair, you do still save that $11,000 that's in your pocket now over your career, but you still net out ahead in that Roth, in this example, just over $26,000. And this is really why we stress at least starting that the Roth IRA, because you still need that 5-year time period. And then at 59.5, you can start taking out any of the earnings. But before that, after the 5 years, you have access to your contributions. But this is the real power of that Roth, is when you get into retirement and we can start to pull additional funds out tax-free, especially for first responders, because you're going to have pension income. Your spouse is probably going to have a 401k. You're going to have some $457 that are going to add to your income. The Roth gives a lot of flexibility so we don't pay more taxes than we have to in retirement.
Thanks, Nick. The thing I would add to this is that this is a pretty conservative projection, right? We're using a $35,000 annual salary. We're using a 15% federal tax income bracket. We're not even tackling the state tax on this particular example. So just think of that for those that are earning more. You're going to be in a higher federal tax bracket. You're going to have state taxes. It magnifies the difference over time, and that's something that we'd be happy to take you through on a personal exercise through our roadmap. That is the bulk of the information, obviously, and we're happy to answer any questions. Like I mentioned, there is a Q&A box. It's in the bottom of my screen. For some of you might be top, left, or right, but please feel free to type in there and we can take a few questions if there are any. And if there aren't any, we can always reach out to us at any time.
Questions are open. You can either use the chat or if you raise your hand, I can unmute you, and I think there's a little hand raising thing. I can unmute you and you can talk on there.
We'll give it another few seconds here.
Yeah. Yeah, so we did get first question that came in here. Can you move money from a traditional to a Roth? And the answer to that is yes. It's called a conversion. And again, we'll work with you and your accountant to figure out how much should be converted, because you're going to pay taxes at that time. So when it moves from your traditional over to your Roth, you do need to pay those taxes or they need to be withheld. So yes, it can be done. But again, we're going to do it with you and your accountant to figure out how much can be converted. And then second question, will you be able to send these slides to us? Yep, if you want any of this information, just reach out to us afterwards. And then this is also recorded. So if you want to go back and view it, just shoot us an email or reach out to Mike or Sean or through the website and we can get it to you.
Hey, one additional thing, Liz, I don't know if you can still bring that up. Can you highlight the QR code, please, for us and
Oh, sure.
talk about where that goes?
Apologies, my screen went black all of a sudden, so
You're running through the slideshow, right? There you are.
Yep.
there we go. All right, that QR code on the bottom, that is actually goes right to our contact us. So if you do have your phone out, if you're not watching this on your phone, hold up your camera and that will take you right to the contact us form.
Perfect. And again, we'd be happy to run through our roadmap exercise with you. And if you're unfamiliar with the term roadmap that we use, please feel free to reach out to Mike and Nick, and they can talk you through how we build a personalized retirement roadmap for you. I'd like to thank everyone for their time, and we will distribute this recording, and we look forward to working with you. Thank you.
Thank you, everybody.
Thank you. Oh, wait, we do have one question here.
Yeah.
Andrew. Go ahead, Andrew. I think you're on. You might have to unmute yourself. There we go.
You guys still there?
Yeah.
Yep.
Okay, I just had a couple quick questions. When we work with WRS, and we have different options, let's say in our deferred through the state, so we can do just the regular deferred comp, or they do have a Roth option on there. If you have another Roth that's outside of that, like for example, I have Edward Jones that I work with. Once you have one Roth, that's it. You cannot have multiple Roths, either with the state or with different entities, correct?
You can contribute to multiple. So if you have your 457 and you're deferring to your Roth in there, you can still add to an outside Roth.
It's
Okay.
just driven by income limits, Andrew. So that's an accounting question, right? You look at your adjusted gross income within the previous year, whether it's your filing single or joint, and then that will drive how much you can contribute outside of your 457 Roth.
Yep.
Is the max 6,500 between the two total, or
No.
can I do it separately, 6,500?
So you can max out your 457 Roth at 22.5 if you're under 50. And then depending upon your income, you might be able to contribute to a Roth IRA. Again, that's a tax accounting question.
Gotcha. And then the other thing too, I think you touched on it a little bit, but as far as if you have money in deferred comp, and then you retire, what is our best grounds as far as moving that? I think you touched on it a little bit, talking about moving that into a Roth or into a traditional at that point to start being taxed on it, like right away, trying to get those taxes to starting to peel off so you don't get taxed on it at a later time.
Yeah, what I would say is that really comes out, Andrew, when we run you through our roadmap exercise. So are you a fireman or a police officer?
Fire.
Okay. I would contact Mike Bongiorno to walk you through this, because what happens is we'll look at your pension projection or actual, depending on if you're retired. We'll look at your balance in your 457, and we'll look at some other variables to see, does it make sense to start converting some of those dollars now versus waiting later? We have a lot of firemen and police officers that will start another job, and therefore their earned income is still pretty high, and it might not make sense to convert some of those dollars in any particular year. Does that make sense?
Yep. No, it does.
Okay.
Leonard, Nick, there's another question in the Q&A.
Yeah, I see that. If you started a Roth through the 457 at the beginning of your career, is there a point where you would want to stop contributing to a Roth portion to go all in on traditional? That's an individual based question, depending upon some other variables, earned income, taxes, spousal income, etc. But I would say in general, no. The only way you stop contributing to a Roth is if you think you're going to be in a lower tax bracket or taxes are coming down. At the end of the day, I would much rather not have to pay any taxes on any dollars coming out of a retirement plan. So, but as we mentioned to Andrew, I really think going through a personal roadmap service, Mark, would be super helpful. So if you're fireman, please reach out to Mike Bongiorno. If you're a police officer, please reach out to Sean Lauda.
Yeah, and I'm just going to add to that, especially as a first responder, there is going to be so much income that you get from that pension. So it's just very unlikely that you're going to save on taxes when you retire. because the tax brackets realistically aren't going to go down. So you're going to likely be in the same tax bracket, or occasionally we see some first responders that actually make more money when they retire because they were dialing down their career, taking less hours, and then retire, they get their full pension, their income's right back up. So it's typically better to have the flexibility of that Roth to know you're not going to accidentally jump yourself up into another tax bracket by needing to take more from your 457 if something happens.
Yep. Cool. I think we tackled all the questions, Liz, right?
I think so. If there's any other questions, feel free to continue. I mean, we still have some time. I know everybody likes getting off on webinars early, so that's fine. But if there are other questions, you can again raise your hand, type in there, or use the QR code, obviously, or contact Mike or Sean.
Perfect.
All right.
All right. Thank you, everybody.
Have a good day.
Great. Thank you.
Bye.